Hello students, in this video I'm going to work through the answers to this practice exam 2 that I recently posted on Blackboard. So let's get started here. There's 23 questions on this practice exam and we're going to try to work through all of them in this video. Number 1, which of the following is not a merchandising company? That would be a service firm. A merchandising company it's a company that sells goods but doesn't manufacture them. So we have the manufacturing firm that makes the goods. They sell the goods to a wholesaler, and the wholesaler will sell the goods to a retailer, and the retailer will sell the goods to the end consumer. That's generally the way it works. And so these two middle entities in the chain, those are merchandising companies. They sell goods to the customer or to the retailer. In the case of the wholesaler, they're selling goods, but they don't manufacture them. Payden Company purchased merchandise from Emmett Company with freight terms FOB shipping point. Who pays the freight costs? So if the freight terms are FOB shipping point, that means that legal title of the goods passes from seller to buyer once the goods are loaded on the shipping truck or whatever is used to ship the goods. Which means while the goods are in transit, the buyer owns the goods, which means the buyer pays the shipping costs. If the terms are FOB destination point, then the legal title of the goods passes from seller to buyer once the buyer takes physical possession of the goods. And so while the goods are in transit, while they're on the truck, the seller owns the goods and the seller would pay the shipping costs. That's the other side of this. Question 3. Glover returned defective goods that cost originally $5,000 that they bought from Mal Company on April 19th. They bought them on credit. They returned the goods on April 19th that they bought on credit on April 10th, $5,000. The terms were 310N30. What journal entry does Glover make whenever they return the goods? Well, that entry depends on the entry that Glover made whenever they originally purchased the goods on credit, which would have been on 410. Glover would have debited their inventory and credited their accounts payable. So when Glover returns the entire shipment to Mal, then Glover gets to reduce the account payable and also needs to reduce their inventory. Keep in mind that Glover hadn't paid yet for the goods. So if they hadn't paid yet and they return it, then there it is. Costner's Market recorded the following events involving a recent purchase of merchandise. They received goods costing $40,000. The terms were 210N30. They paid $200 freight on the shipment. This is the first thing that happened. This should be the second thing that happened. Then they returned $800 of the shipment for credit. And then finally they paid the invoice of what they owe within the discount period. As a result of these events, the company's inventory, the company's inventory should increase by the amount of cash that they ended up paying for the goods. That's the answer to the question. But let's go through this with journal entries and T accounts to make you understand the answer. We can get the answer really easily by just figuring out how much cash did they pay for these goods. They purchased $40,000 worth of goods on credit. They paid no cash there. Then they returned 800 of them, so they owe $39,200, and they pay within the discount period, so they end up only paying 98% because they get a 2% discount. So they end up paying that amount of cash for the goods, plus the $200 to ship the goods to the, Costner's is the buyer. They paid $200 for the goods to be shipped. Usually the buyer has to pay the shipping because the terms are usually FOB's shipping point. And so there's the total amount of cash they've paid, and that's the amount that their inventory should be increased by. So C is the answer, but it's harder to see that that's the answer, doing it this way, than another way. Let's do it a different way. I'll put down here, though, inventory increases by exactly cash paid for the goods, including shipping if they had to pay shipping. Shipping cost is added to the inventory account. So let's do it this way now. Let's do it with two T accounts, one for inventory, one for accounts payable. They purchased stuff originally, $40,000 on account. So they would debit inventory. They would credit accounts payable. I'm not making the journal entry. I'm just putting the journal entries into the T accounts. Then they paid $200 freight on the shipment. So they would debit inventory and they would credit cash. You got to pay cash to ship stuff. The shipping company doesn't allow you to have an account payable with them. So debit inventory, credit cash. Then they return $800 for credit. So credit inventory and reduced the account payable by $800. Then they paid the invoice within the discount period. Well, what do they pay? How much do they owe as of now? They owe $39,200. And they pay that within the discount period. So they're able to satisfy a liability that's worth that much by only paying that much in cash. So the journal entry when they pay the invoice. Here's the journal entry when they pay. We'll make the journal entry. They get to reduce their account payable by debiting it for its balance. Reduce the liability by the complete amount. So debit account payable for $39,200. So there's a zero balance. There's no more account payable. Credit cash for 98% of that, $38,416. And the other credit, so that the debit's equal to credits, has to go to inventory, and it's equal to the discount. You have to credit inventory for the discount. If you don't credit inventory for the discount, if you don't credit inventory right here for $784, but you credit something else, then what happens? Then the balance in the inventory account would be 40,200 minus 800, which would be 39,400. But how much have we actually paid in cash for this inventory that we say is worth 39,400? We've paid 38,616 because we've already figured that out. Right? We've paid this and this, 38,616. So we've paid in cash 38,616 and our inventory account has a balance of 39,400. That can't be. That's not right. The balance in inventory has to equal exactly what we've paid in cash. So the only way for that to happen is we have to credit inventory here for the 784 discount. And once we do that, then the balance in inventory will be 38,616, right? 40,000 plus 200 minus 800 minus 784, 38,616. And this is how much inventory increased by. Because this inventory was 0 at the beginning, and at the end it's 38,616. So as a result of these events, this company's inventory increased by 38,616. So you can either think of it this way, or you can think of it this way with the T accounts here and making the right journal entry for when they pay the invoice, realizing that the inventory account has to be credited for the discount. Now, if they pay the invoice outside of the discount period, then this journal entry, there wouldn't be any discount. So you'd just be debiting account payable for the same amount that you're crediting cash. But if they pay the invoice within the discount period, then you're always going to have that credit to inventory for the discount. All right. A little bit trickier one. We went through that in class, though, when we talked about this chapter 5. Oh, yeah, and these 23 questions, I believe the first 8 are chapter 5. The next 8 are chapter 6. And then the final 7 are chapter 7. I believe that's the breakdown on this practice exam. So questions 1 through 8 are chapter 5. 9 through 16 are chapter 6. And then 17 through 23. Or 9 through 15. Maybe I've gotten them. What does that add up to? 8 and 8 is 16 plus 7 is 23. Anyway, the first 8 are chapter 5, the next 8 are chapter 6, and the last 7 are chapter 7. Number 5, McIntyre Company made a purchase of merchandise on credit from Marvin. So we got buyer, we got seller. On August 8th for $9,000. Terms were 310N30. 9 days later, on August 17th, McIntyre makes the appropriate payment to Marvin. When McIntyre pays Marvin, what journal entry does McIntyre make on 17th? Well, they're paying within the discount period, and so we know the journal entry has to take this form. There's got to be a debit to account payable, a credit to cash, and a credit to inventory for the discount, just like this journal entry here. And since D is the only journal entry that takes that form, you can automatically know that D is right without even having to calculate anything. When the buyer pays the seller within the discount period, the journal entry from the buyer's perspective on the date that they pay the seller is always going to look like this. They're going to debit account payable, credit cash, and then credit inventory for the discount. Assuming the buyer is using the periodic inventory system and not perpetual inventory system. But you were allowed to assume that in chapter 5. The perpetual system is in the appendix to chapter 5, which you're not responsible for. So we could go through it again with the inventory and account payable T accounts. We can go through 5 again and get the actual numbers like we did in number 4. But in the end result is it's going to be D. It will be the entry. So very similarly like we did. 5 is easier than 4 because there's no shipping in 5, so this doesn't exist. There's no return, so this doesn't exist. You just have this and this in the inventory account. And in the account payable account, you just have this. You don't have this. Yeah, it's pretty simple. If a customer agrees to retain merchandise that is defective because the seller is willing to reduce the selling price, this transaction is known as a sales. It's an allowance. So let's say, example, buyer buys 3 TVs from seller at $1,200 each on credit. Upon receipt of the TVs, buyer realizes one of them. Let's say, what are we going to say is wrong with one of the TVs? One of them has a chipped frame. But otherwise works as new. So the functionality of the TV is fine. It just has a chipped frame. So seller agrees that they will, or we'll say it this way. So buyer agrees to not return the TV to seller for a replacement, as long as they being the buyer only has to pay $1,000 for it instead of $1,200. So if the seller will reduce the price from $1,200 to $1,000, the buyer will keep the TV. Otherwise, the buyer, if the seller still says, buyer, you got to pay $1,200, and the buyer says, no, here's the TV back because that's not what I ordered. Give me a brand new one, and I'll pay $1,200 for a brand new one. This is an allowance. Arquette Company's financial information is presented below. Sales revenue is unknown, gross profit unknown. What are the unknown amounts? Well, there's 2 formulas that this question is testing. The formula for net sales revenue, which is equal to sales revenue, or gross sales revenue, minus the balance in sales returns and allowances, minus the balance in sales discounts. And so we got 900,000 equals X minus 40,000 minus 0. There is no sales discounts. So something minus 40,000 equals 900,000. So X equals 940. So we're left between, you can rule out B and D. We're left between A and C because they both have 940 for sales sales revenue. And then the next formula that this question is testing your knowledge of is the formula for gross profit, and gross profit is equal to net sales revenue minus cost of goods sold. So X equals net sales revenue of 900,000 minus cost of goods sold of 540. So X equals 360. And so we can rule out C, and we're left with A being the correct choice. A company shows the following balances: sales revenue, sales returns and allowances, sales discounts, COGS. What is the gross profit rate? So the gross profit rate, or percentage, is equal to the gross profit divided by the net sales revenue. And the net sales revenue is equal to this formula. So we first need to get net sales revenue. So net sales revenue is equal to gross sales revenue, or sales revenue, 2.5 million, minus sales returns and allowances, the balance in that account, minus the balance in sales discount. So there is net sales revenue of $2 million. So that's in the denominator. And then gross profit, what is gross profit? It's equal to net sales revenue, right? We just have the formula up here. Gross profit equals net sales revenue minus cost of goods sold. So we have net sales revenue minus cost of goods sold divided by net sales revenue. That's gross profit rate. That's the gross profit rate. And then if we multiply that by 100, then that turns it into a percentage. So I guess technically you got to multiply by 100 to convert if we want the actual gross profit percentage. Technically the gross profit rate is just this, but all the answers are in percentages. So they must be asking for the gross profit percent, not rate, to be precise. So 2 million minus 1.4 million is 600,000. 600,000 divided by 2 million is the same thing as just 6 divided by 20, 30%. Number 9. Switzer Incorporated has 8 computers which have been part of the inventory for over 2 years. Each computer cost $600 originally. So they're on the books at $4,800. So their inventory account currently has a balance in it of $4,800 on their books. It's the current balance. The original retail price is not relevant in this problem. It's just extra information given to you to hopefully throw you off. At the balance sheet date, each computer has a net realizable value of 400. So each of these computers that we originally paid 600 a unit for, so that we had 8 of them, so they're on our books at 4,800. But each of these computers right now can't be sold for any more than $400. So we have to mark down our inventory. Right? This question is testing your knowledge of the lower of cost or net realizable value method. What is lower, cost or NRV? Which one's lower? NRV is lower. So we have to record our 8 computers at NRV. So the balance in our inventory account needs to be 3,200, and it's currently 4,800. So we're going to have to write down our inventory by the difference, by whatever 4,800 minus 3,200 is. Or another way to say it, we have to write down each of our units by $200 times 8 units, $1,600. 4,800 minus 3,200. We have to write down our inventory, which means credit inventory for $1,600 and debit cost of goods sold expense. So it's a loss. Even though we don't sell them yet, we're debiting COGS. It's a loss. It's an expense. So 1,600 is the answer. The journal entry for the write down, debit COGS, credit inventory. There's the credit to inventory. So now the balance in inventory after this is 3,200. That's the balance in the account now after writing it down by 1,600. Which of the following should be included in the physical inventory of a company? So a given company is not supposed to include goods that they're holding on consignment from another company. So we'll call the company in question A. So your company A, if you hold goods on consignment from company B, which means company B allows you to have their goods. You don't own them. Company B still owns them. And you sell them for company B. And then you give company B the proceeds from the sale, and you keep a little bit of the proceeds, as a fee that you charge for selling it for them. A doesn't get to call that inventory A's inventory. That's still B's inventory. So not A. Not letter A. A can't. Letter A is not an answer. Goods in transit to another company shift FOB shipping point. So if A has shipped goods to company B and the terms are FOB shipping point, can company A call those company A's inventory? No, because if the terms are FOB shipping point, legal title of the goods passes from the seller, company A, to the buyer, company B, once their goods are loaded on the shipping truck. So if the goods have been shipped, they're company B's, not company A's. Therefore, company A cannot count them as part of their inventory. So not choice B. Choice C, goods in transit from another company shipped FOB shipping point. Yes, if things are being shipped to company A and the terms were FOB shipping point and they're in transit, that means company A owns them. And then so C is correct. And once you know C is correct, two answers can't be correct. So you know D's wrong without even having to think about D. Number 11, Partridge Bookstore had 500 units on hand at the beginning of the month, costing $9 each. Purchases and sales during the month of January are below. Partridge does not maintain perpetual inventory records, which means they use a periodic system. According to a physical count, $365 units were on hand on January 31st. Oh, this reminds me. I said something wrong earlier in the video. It had to do with question 4 and question 5. In question 4 and 5, this is chapter 5. And in main chapter 5, we're assuming the company uses a perpetual system. And if they use a perpetual system, then all of this is true, what I said here. The appendix to chapter 5 is if the company uses a periodic system. And you're not responsible for that. Down here in question 11, we're in chapter 6 now. And in chapter 6, in the main chapter 6, we assume the whole time the company used a periodic system, not a perpetual system. The appendix to chapter 6 is a perpetual system. But the company is using a periodic system. So at the end of each period, they make a physical count. They find that 365 units are on hand at the end of January. And so what's the ending balance in the inventory account? If we're trying to estimate the ending balance in the account using the FIFO method, call this X. What is X? Well, beginning inventory is 500 times 9, $4,500. Purchases during the month, they made a purchase on the 17th, 250 times 10. They made a purchase on the 25th of January, 250 times 11. So total purchases are 5,250. Cost of goods sold, we don't know. Call that Y. The ending balance in the account, we'll call that X. They're asking for X in this question. But we don't know X. We don't know Y. Now, there's two ways we can do this. We can either just apply the FIFO method, directly and get X without even having to get Y. Or we can apply the FIFO method to get Y, and then once we get Y, we can subtract Y from the sum of these two numbers. And the sum of these two numbers, again, is known as the cost of goods available for sale. Cost of goods available for sale minus cost of goods sold equals the ending balance. So there's two different ways we can do it. Let's do it both ways. So the first method, we'll just estimate X directly without first estimating Y. So there's 365 units left at the end of the month. If we want to estimate X directly, that's the first thing we need, is how many units are on hand. Now these 365 that are sitting there on January 31st, what units are they? Are some of those 365 some of the ones that were sitting there at the beginning of the month? Are some of those 365 ones that we purchased on the 17th? Are some of those 365 ones we've purchased on January 25th? Depending on which units these are three different costs, right? So that will alter the value of X. If we assume FIFO, the first units to come in, and the first units that came in were the units that were already sitting there at the beginning of the month. The first units to come in are the first ones to go out, FIFO, first ones to be sold. And therefore, whatever's left over at the end of the month must be the most recently purchased units. So with that assumption, from the perspective of the end of the month, what are the most recently purchased units? The ones purchased on January 25th. So we're going to assume that these 365 that are left over that haven't been sold, that 250 of those 365 are left over from the January 25th purchase. And each of those we purchased for $11. And the rest that are left, that are sitting there at the end of the month that haven't been sold, we're going to assume those 115 are left over from the January 17th purchases. So we attach a cost of $11 a unit to 250 of the 365 units. And we attach a cost of $10 a unit to the other 115 of the 365 units. So our ending inventory would be valued at this using FIFO. And then 250 times, or 115 times 10 is just 1,150, but we add that to 2,750 and we're at 3,900. So C is the answer. That's one way to do it. Second way to do it is first estimate COGS, estimate Y, and then when you get that estimate for Y, then subtract that from the cost of goods available for sale, and that'll give us X. So let's do that method. So our estimate for cost of goods sold, we first need to figure out how many units did we sell. We sold 375 on January 14th. We sold 260 on the 29th. So these 635 that we sold, which units were they that we sold? Depending on what units they were, we're going to attach different costs to them. Again, we have 3 costs this month. If we assume FIFO, first in were the first to be sold, then these 635 that were sold, the first ones we sold were the ones at the beginning of the month. And each one of those units cost us $9. We sold those first. Those were purchased last month. And when we purchased them last month, they must have cost $9. That's why they're sitting there at the beginning of this month with a $9 cost each. So we sold 635 in January. The ones we sold first are those 500. And that leaves 135 that we still need to sell. And the next 135 we sold from the January 17th. If we're doing a first in, first out assumption. And each of those 135 was purchased for 10. So the cost of goods sold, the cost of these 635 that we sold, if the ones we sold were these 500 and then 135 of these 250, then the costs would be 500 times 9 plus 135 times 10. And the COGS would be this number. $58.50. That would be COGS. And then the second, then what we would do is subtract the $58.50 from the cost of goods available for sales. Then we would take $4,500 plus $52.50 and subtract $58.50. And again, you're going to get $3,900. You're going to get the same thing. Whether you use method 1 or method 2, you're going to still get the same answer. Let's make sure we do. 4,500 plus 52.50 minus 58.50 equals 3,900. So given these two methods, you're probably going to use method 1 because it's the shortest and the quickest. Just directly estimate X and not use method 2. 12. Inventoriable costs include all the following except. So again, we have our inventory T account. The cost of beginning inventory is included. The cost of purchases is included. The sum of those is the cost of goods available for sale. And any freight costs. Actually, if there's freight costs as well, then the sum of all of this is cost of goods available for sale. Those are included. What's not included is the cost of the purchasing and warehousing departments. The cost to purchase the inventory is right there. But the cost of the purchasing department, the costs, and the costs of the warehousing department, the department that houses the inventory. Other costs, not the cost of purchasing the inventory, but other costs of those departments, like paying people their salaries who are working in those departments. Those are not part of our inventory cost. So B is the correct answer. Inventoriable costs include all of the following. They include A, C, and D, but they don't include B, except B. 13, a company just starting business made the following 4 inventory purchases in June. Okay. A physical count of merchandise inventory at the end of the month reveals that there are 250 units at the end of the month. Using the LIFO inventory method, the value of the ending inventory on June 30th is... So 13 and 11 are similar. In 11, we're valuing the ending inventory balance using FIFO, and in 13, we're valuing the ending inventory balance using LIFO. So there's 250 units left. Which 250 are they? Well, if we assume LIFO, last in are the first to be sold. So whatever's left over must be the oldest units. So from the perspective of the end of the month, what are the oldest units? These units at the beginning, those are part of the 150 that are left over at the end of the month. We're assuming, if we assume LIFO. And each of those units was purchased. It doesn't tell us what each one of those units was purchased for. It just tells us, well, we'd have to do 390 divided by 150 to get the per unit, but 390. If you want to, we don't have to do this, but we can, if you want to get the per unit. So 390 divided by 150. Oops. This is going to make the problem longer. We don't need to do this, but 2.6 And then on 585 divided by 200, 2.925. And we don't have to go further. All right, these 250 left at the end. 150 of those are left over from the beginning, and each one of those was purchased for $2.6 a unit. So that will equal $390. And then that takes care of 150 of them, and the other 100 of them are left over from these 200 units that were purchased on June 10th. And each of those 100 was purchased for $2.92.5. So this is 390. And I guess this number would be half of 585. So 150 times 2.6 plus 100 times 2.925, 682.5. And you can round to the nearest dollar. All right. 14. The following information was available for Peat Company on December 31st, 2027. Beginning inventory, ending inventory, COGS, sales. What's their days in inventory? So you're allowed to bring your cheat sheet to the exam, and on your cheat sheet you can have some formulas written. There are a lot of formulas that we've learned in these chapters 5 through 7. But one of them was the days in inventory, which is equal to the 365 days in a year divided by the inventory turnover. And the inventory turnover is how many times in a year you turned your inventory over. And the inventory turnover, so we have to compute inventory turnover first to even be able to compute days in inventory. Inventory turnover, the formula for that is cost of goods sold divided by the average inventory balance. So we have 984,000 total cost of goods sold whenever we sell inventory or turn it over. We have COGS. That's when the COGS comes about. So it makes sense to compute inventory turnover as the dollar value of the cost of goods sold divided by the average dollar value of our inventory that we had on hand this period. So we had 90,000 at the beginning of the period. We have 70,000 at the end of the period. And on average, if you divide that by 2, there's $80,000 of inventory we had on hand. So 984 divided by 80 is 12.3. So our inventory turnover is 12.3 times, which means our days in inventory. So this is days in a year. This is times per year. And then the years cancel and we're just left with days per time. So we turned our inventory over. We got a bunch of inventory and sold it all 12.3 times in this year. So on average, how long does it take us to do that once? About 29.67 days. Or when you round 29.7 days per time. About a month to sell all our inventory. If we did it 12 times in a 365-day period, then it takes us about 30 days to do it once. 15. Othello Company understated its inventory by $20,000 in December 31st, 2020, on December 31st, 2027. It did not correct the error in 2027 or 2028. As a result, Othello's stockholders' equity was understated or overstated at the end of 2027, and then understated or overstated at the end of 2028. Well, ending inventory in 2027 is beginning inventory in 2028. So if ending inventory in 2027 is 20,000 too small, do a T account for inventory 2027, 2028. And let X equal the inventory that was reported. Which means it's wrong. Now, beginning inventory, purchases, those are known and are fine. But if the company understates its ending inventory, that means COGS in 2027 is going to be overstated. Does that make sense? Assuming that these are correctly stated, we know there's a formula. Beginning inventory plus purchases minus COGS equals X, equals ending inventory. If X is 20,000 too small, then COGS must be 20,000 too big. Too big or overstated in 2027. And cost of goods sold is an expense. And so if we have an expense that's 20,000 too big as of 2027, then that means owner's equity will be 20,000 too small in 2027. Expenses reduce owner's equity, and we're reducing owner's equity by too much. So owner's equity will be 20,000 too small. So we can rule out C, and we're left with choices A, B, and D. All three of those have owner's equity understated, too small, which is correct. But now we have to think about what about in 2028? So ending inventory in 2027 becomes beginning inventory in 2028. Keep in mind that X is still 20,000 too small. Then we add our purchases in 2028. Let's assume that the ending inventory in 2028, the ending inventory, is correctly stated. We'll just call it ending inventory. And that's correct. So this is right. This is right. This is incorrect. Then what will COGS be in 2028? Will it be too small or too big, or will it be correctly stated? So we have X plus purchases. This is correctly stated. This is not correctly stated. X plus purchases. So X, beginning inventory in 2028, is understated by 20,000. Plus purchases minus COGS equals the ending inventory, and this is correct. Let's solve for COGS. Beginning inventory plus purchases minus ending inventory equals COGS. These are both correct, and this is understated. This is too small. So we got beginning inventory is too small, plus purchases. It should be bigger. Plus purchases minus ending inventory makes COGS COGS will be understated in 2028. You see that? Talking about 2028. We already figured out 2027. In 2027, ending inventory X was too small, which made COGS too big in 2027, which made owner's equity too small. In 2028, X is now the beginning inventory. It's still too small, plus purchases, which is fine, minus the ending inventory in 2028, which we're assuming is fine. It didn't say that they made a mistake there, equals COGS in 2028. But now, since X is the beginning inventory and it's too small, then COGS is going to be too small in 2028. The opposite of what it was in 2027. So if COGS is too small, if it's understated in 2028, and it's an expense, we're subtracting that expense, COGS, but we're subtracting too little, then our owner's equity is going to be too big, overstated in 2028. So we can rule out B and D, and we're left with A. Owner's equity is understated as of the end of 2027 because COGS is too big. And owner's equity is overstated as of the end of 2028 because COGS is too small. The effective inventory errors. It will be on exam 2, and it can be a little tricky. (16) Control over cash disbursements is generally more effective when all bills are paid in cash. Well, that would make it harder to have control over cash disbursements. If everything is paid in cash, you have to keep track of all of that. Make sure that everything that's paid in cash is correct. So that would not be an answer. Generally more effective when all purchases are made on credit. Well, whether the purchases are made on credit or not, this is about when the purchases are paid for. So that's not really relevant. If all payments are made by check, yes, that makes it easier to ensure that you have good control over your cash. If disbursements are made by the accounts payable subsidiary clerk. Probably that would make control less effective because the accounts payable subsidiary clerk is the one who records the account payable and records that when the account is paid off, records the decrease in the liability, the debit to accounts payable and the credit to cash. And you don't want the same person having record-keeping duties also having physical custody of the cash and making the payment themselves. So that would actually go against control. So the only answer is C. If we make payments by check, we're less likely to have people stealing cash because we're not paying in cash. It's just check. Reconciling the bank statement monthly is an example of documentation procedures. Segregation of duties, it's not really relevant. We're not talking about having different people do different things here. Actually, sorry, I think it's not documentation procedures. It's independent internal verification. Usually the internal audit department at the company is the one that reconciles the bank statement. They get the bank statement directly from the bank and they reconcile what the bank says we have in our account to what our cash T account says we have in our account. It's all about cash. So it's B. People internal within the company, so they have to be internal because they have to know what we have in what our records say we have, our cash T account. But they're independent in the sense that they can just see the record, but they don't have record keeping duties. They're not ones that make journal entries in the cash T account. Internal audit doesn't, they don't have authorization to pay any cash for the company or anything like that. They don't have physical custody of the cash. They're just internally verifying that what the cash T account says we have is what the bank says we have. 18, a petty cash fund of 100 is replenished when the fund contains $4 in cash and receipts for 93. So as of the time of me making this video, we haven't talked about this yet, petty cash. It's in chapter 7, but once you attend that lecture and you see what we have to say about petty cash, then my answer to this question will make more sense to you. But basically, petty cash fund is set up for the company to make small purchases from with actual cash. So we generally want everything paid by check. Anytime we want to pay for something, we pay by check. But what if we want our company to, like, what if we need office supplies or some little small, incidental items that have to be purchased relatively frequently? If we're always having to write a check for things like that and they're all small dollar amounts, that can take longer and be more cumbersome. And so what companies will do is they'll establish a petty cash fund. It's basically like a little stash of cash where the company can make these little small incidental purchases. And so the journal entry to establish the fund is, the way they establish the fund is the company will write a check to themselves. You can write a check with yourselves being the recipient. You take the check to your bank, you sign it. That way you have a legal document that you wrote a check to yourselves, and then the bank gives you $100 out of your account. So that's what they do physically. And then the journal entry that has to be made is debit petty cash, credit cash, let's say for 100. And now we have $100 in our drawer, that we can use to spend for incidentals. At the end of the period, what they're saying is there's $4 left in the drawer, which means there should be $96 worth of receipts to account for the other 96 that was spent. If there's $4 left in the drawer and there was 100, if there was 100 at the beginning and there's 4 at the end, we spent 96. So we should have receipts for the 96. But there's only receipts for 93. And we want to replenish the fund. The entry to replenish the fund so the journal entry would be, the physical thing they would do to replenish the fund is they would have to go write a check to themselves for $96 so that the fund has $100 back in it. What's the journal entry? Credit cash for 96. And we need to debit a bunch of expenses for the receipts. So if the receipts was for office supplies or just miscellaneous types of things, so we would debit miscellaneous expense for the 93. And the difference goes to an account called cash over and short. So 2 debits and 1 credit. Debit miscellaneous expense for the various things that we have the receipts for that we spent the money on. Debit cash over and short. Credit cash. That's the journal entry. And you might wonder, well, we're supposed to have $96 in receipts. $96 was spent, but we only have $93 worth of receipts. That means somebody stole $3. Well, yeah, it could mean that, or somehow it got misplaced. We're not looking really at why that happened. This is the journal entry, though, that would be made. So C is correct. 19, an exception to disbursements being made by check is acceptable when cash is paid from petty cash. We just talked about that. So we want to establish this as our main rule here. All payments are made by check, so we have more effective internal control. It's less likely for cash to be stolen. An exception to that policy is if we, use some cash out of the petty cash fund to buy stuff. All right, the cash account shows a balance of $40,000 before reconciliation, so this This question is all about the bank reconciliation, which is a Chapter 7 thing, which we're going to talk about here coming up in lecture. As of me making this video, we hadn't talked about it yet. But the bank statement does not include a deposit of $9,200. All right, so with the bank reconciliation, we're taking our cash T account, looking at its balance at the end of the period. So the internal auditor does this. The balance in cash, let's say it's $40,000. That's the unadjusted balance. We haven't adjusted it yet at the end of the month. We're taking that balance and we're comparing it to what the bank statement says we have in our cash account. The bank statement comes from our bank. That's what we're doing on the bank reconciliation. Now, this question is all about what's the correct balance in the cash account. On the bank reconciliation, you can think of it as a document. We have two columns. We start with we have the unadjusted bank balance. This is what the bank says is in our account. We start with that, and then we make some adjustments to the unadjusted bank balance to get the adjusted bank balance. In the next column over here, on the bank reconciliation, there's two columns. Adjustments to the bank, adjustments to the books. We have the unadjusted book balance, which is this $40,000 they told us. They didn't give us the unadjusted bank balance. They didn't give us the balance that our bank says we have in our account at the end of the month. They didn't give us that, so we don't have that. That's unknown in this problem. They gave us some of the adjustments, though, that we would make to that number if we knew that number. Adjustments you make to the unadjusted bank balance, you always adjust the bank balance for deposits in transit. And outstanding checks. And then bank errors. Those are really the only three things you adjust the unadjusted bank balance for. They gave us information about deposits in transit. They did not give us information about outstanding checks. So I won't put a check beside that. And then any bank errors. Those are really the only three things you ever adjust on the bank side of the bank reconciliation. This is the bank side. This is the book side. The book side usually is a little more complicated. You make more adjustments to the book side than you do to the bank side. There's just these three things you do on the bank side. Deposits in transit, outstanding checks, and bank errors. And we'll talk about this in class. But in this problem, they don't give us this, and they don't give us this here, outstanding checks, and they don't give us any information about bank errors, which you can assume if they don't, then that means there weren't any bank errors because the bank doesn't make an error very often. But they don't give us the information we need to even be able to do the bank side of the bank reconciliation. We're going to go over here on the book side and do it. So the book side, you start with the unadjusted book balance, you make some adjustments to it, and you get the adjusted book balance. And what do you think has to be true? Whatever you get for the adjusted bank balance and whatever you get for the adjusted book balance, they need to equal each other. If they equal, that means your bank reconciliation is correct. That means the adjustments you made on either side are correct. So as a hint for the exam question, you may see on the exam that I may give you the same question, but I'll change the question. I'll give you exactly the same information in this question except this last sentence. I'll say, the correct balance from the bank's perspective, the correct bank balance in the cash account was what? I'm asking for this. If I ask it that way. The way they're asking it, the correct balance in the cash account, they're asking for the balance in our cash T account. They're asking for this. But if I ask, what's the correct bank balance in the cash account? You'd go about solving it the same way. You get the correct balance on our books, and you know that if you get the right number there, then it should equal this number. So you would still answer the same thing. You see what I'm saying? Don't get thrown off by that. Because if they ask for this number, and you go and try to use the bank side of the reconciliation with the information it's given, you're not given all the information. You can't even do it this way. You have to go down this side, get this number, and then realize that these two have to equal. So just a hint for the exam. All right. So they're asking for the adjusted book balance. That's what they're asking for. That's what this question is asking for. The correct balance in the cash account after adjustment. Before adjustment, it's $40,000, but that's not correct. After adjustment, it is, well, what adjustments do we need to make to the books? So let me erase all this stuff because it's getting cumbersome. What adjustments do we need to make to the books? These adjustments here, what are they going to be? We always make adjustments we don't make adjustments for any deposits in transit. We look on the bank statement, anything that has happened in our bank account that is not on our books already. Those are the things we adjust the book balance for. This deposit we made at the end of the month, that's already on our books. We've already credited cash for $9,200. That already is reflected in this number. So we don't need to make an adjustment for that. It's not showing up on our bank statement because we did it at the last day of the month. We brought the money to our bank, we recorded it in our books, and the bank just hasn't had time yet because the bank statement is done at the last day of the month to show up in the bank. It'll show up on next month's bank statement. But that's not something we adjust the books for, book side. But some things we do adjust the book side for. It says the bank statement shows the collection by the bank of $39.60. We don't know about that the bank collected $39.60 on our behalf from one of our customers until we look at our bank statement. When we see that, then we know we got to go adjust our books. We got to go debit cash and credit accounts receivable. They've collected on our behalf from one of our customers. Also on our bank statement, so we took care of that. Also on our bank statement, we see a customer's check for $1,300 was returned because it was not sufficient funds. So the way that works, this is the check that we've already recorded on our books as having received, because we got the check from the customer in the past and it's paying off one of their accounts. So we would debit cash $1,300 and we would credit their account receivable. Then we take the check to our bank, and the bank originally puts the money in our account like a temporarily, it sits there, but it's not really there yet. Then the bank has to make sure that the check clears. And what the bank is telling us is that check that you thought had cleared didn't clear. So the bank takes the money back out of our account, and we better take the money back out of our account. Not sufficient funds checks are always subtracted from the book balance, from the unadjusted book balance. And then finally, any book errors. So a customer's check for $1,380, there's two errors here, was recorded on the books as $1,920. So a customer mailed in a check to pay off their account. It was written for $1,380 and they wrote it correctly. But we recorded it, when we got the check, we debited cash for $1,920 instead of $1,380. And we credited their account receivable for $1,920. But we debited cash for $540 too much. So we better take out that $540. But we said $1,920 was going into our account, but only $1,380 went into our account. The bank honored the check for $1,380, not $1,920. We just made an error in recording it. We put $1,920 in our cash T account, but that was $540 too much. So we better take it back out. And then finally, a check. So this was a check that we received from our customer. And now here's a check that we've written. We wrote the check for $318, but we recorded that we wrote it for $390. So we wrote a check ourselves to pay for something. We wrote it for $318 to pay for something. So that's correct. $318 is right. But we recorded that we wrote it for $390. So we credited cash for $390 and debited, some miscellaneous expense or something for $390, but we should have done it for $318. So we took out $72 from our cash account, more than what that actually came out of our cash account. So we need to add that back. Add that book error back. So we have our unadjusted book balance. Add the collection by the bank that we just saw in our bank statement that we didn't know about. That's not on our books. Subtract the not sufficient funds check. That is on our books, but it's wrong because the money didn't come in, actually, so we had to take it back out. And then add and subtract these two book errors. So our adjusted book balance, we have $40,000 plus $39.60 minus $1,300 minus $540 plus 72, $42,192. Now let's make sure that's correct, because I don't want to lead you astray. So 20 is B. Yeah, 20 is B in the answer key. So hopefully that makes sense. Again, that's kind of a tricky one. The bank reconciliation, you have to think about it. I went through it, bank side, book side. This problem only gives us the information we need to answer using the book side of the bank reconciliation. Now, what if this problem had given us, it gave us a deposit in transit right here, and if it had given us outstanding checks, and then said that there weren't any bank errors, and then asked for the correct balance in the cash account, which means the adjusted book balance, and gave us all this other information, it would be easier to go down the bank side of the bank reconciliation than to go down the book side. It would just less calculations, and we'd still get the same answer. So I'd go down the bank side in that case. Now it would have to give us the unadjusted bank balance as well, and then the deposits in transit, and then the outstanding checks, and then any bank errors. Usually the bank doesn't make an error. And we can go down the bank side and get the adjusted bank balance, and that should be the same thing as the adjusted book balance. We don't even have to go down the book side, because this side is usually more complicated going down this side than going down this side, less complicated. Another thing to keep in mind is that any adjustments we make over here on the book side, these are adjustments that involve a journal entry. We're going to have to make a journal entry to update our books, obviously, because our cash T account is off. And after making those journal entries to change cash, then at the end, the cash account should have a adjusted balance of $42,192. This is the balance that goes on our balance sheet, not this. All right, cash equivalents could include each of the following except. So cash is coins, currency. Cash is coins, physical currency, like paper money. Checks are called cash as well. If you have a check from someone that's as good as cash, you can call it cash according to GAAP. And then cash equivalents are things that are short-term investments, usually less than 3-month maturity. They're not cash, but you can convert them to cash really quickly. But the key thing is that they're not cash, but they can be converted to cash really quickly within 3 months. So that's a cash equivalent. CD, money market fund, is a cash equivalent. And a U.S. Treasury bill, as long as it's 3 months or less, it's not more than 3-month maturity date, then that would be considered a cash equivalent. But petty cash is not a cash equivalent, so that's the right answer to this question, because it says which of these is not a cash equivalent. And the reason petty cash is not a cash equivalent is because it's cash itself. It's not a cash equivalent, and it's not an investment. So, all right, having different people receive cash, record cash receipts, and then hold the cash is an example of having different individuals. So I guess that's segregation of duties. 22B. Yeah. A system of internal control, we talked about this in class. Despite the best controls, the best segregation of duties, one thing can override that always, and it's if employees decide to collude together. So a system of internal controls is not infallible. All systems of internal controls are fallible. A system of internal controls does not have to have cost exceeding benefits. In fact, you don't implement a system where the cost of to put in those controls are greater than the benefits. So that's not true. And a system of internal control is premised on the concept of absolute assurance. No, it's premised on the concept of just reducing risk. You're never going to drive risk to zero. You're not going to have absolute, 100%, there's zero risk. So no. But it can be rendered ineffective by employee collusion. So B. And that takes us through this exam, practice exam. Notice there were some qualitative questions from the PowerPoints. There were some quantitative questions. Some of the questions were tricky, a little bit harder. But I hope this review is helpful for you. And I will see you in class.